Hey, JJ here with the Art of Value. So today I'm going to talk about going back to some market commentary and also to talk about bubbles, in particular bubbles, and this Nasdaq bear market that we're in, and S&P 500 not quite in a bear market, Russell 2000 in a bear market. So let's have a look at the heat map for today. The Apple was down 2.46%, which was pulled things down a little bit, but it's a mixed bag. If you're on Spotify video or YouTube, you can see this heat map here. So a bit of a mixed bag today, and same with the indices. The S&P 500 down 5.58. The Dow down is 0.75. So those are sort of not catching up to the Nasdaq, but they're having, we're talking about the generals being shot. It's a war term, being shot last. Eventually they come for the general. So the Nasdaq was down 0.2, not as much, and the Russell 2000 actually managed to gain, which is the second time this week that's happened where the others have been down and the Russell been up, which is what I like to see. Got some small cap stocks, and Russell 2000 is the first to go down, first to go up. It has historically, I think, been like that. Can't confirm that, but I think that's the way sometimes it goes in this kind of environment anyway. So this headline from today from Bloomberg, question of the day: where does the stock drop stop? That's a bit hard to say, but we'll look at a video and the answer to that question in a minute. But the indices from all-time highs, the Nasdaq down now 29%, 29.1%, so firmly in bear market territory. The S&P 500 down 18.9, not quite bear market, technically at 20%, but nearly there now. And Russell 2000 down and firmly in bear market territory as well. So let me have a look at this video. What this guy says about when will the stock markets drop? When will the stock drop? Stop. And so this guy, I don't know who he is actually, but let's see what he has to say.
That we do shows that we are in a downtrend. So you talked about the bear market, and I know that there's a 20% qualification for that, but most of the characteristics that we look at have suggested that we've been in a bear market for about 6 weeks now, and I think we're going to continue to see that. I think one of the things that's going to be important is seeing the market start to discount this peak inflation idea and getting through peak inflation. And if you look at the performance of energy, you look at the performance of yields up until about a week ago, certainly we weren't there yet. But I think that's going to continue. We think that the market trades somewhere between 3,500 and 3,600 as a minimum to get us into that zone. The good news is, and there is some good news, is that you started to get into a situation where there's nowhere to run, there's nowhere to hide. They took out Apple last week. They took out some of the staple names here this week. Obviously, Walmart, which is a safe haven type of name. Who doesn't go to Walmart regardless of the economic conditions? And so once you start doing that, you start getting into the very end of these bear markets historically, and I think that's good news that we can point to today.
All right, so that's what he said. He's basically saying the generals are getting shot. Where they took out Apple last week, Walmart, Target. Target went down like more than 20%. This is actually he's Jeff DeGraff from Renaissance Macro Research. That's who he is. And so yeah, interesting to say that he's doesn't know when it'll stop, but it's at that time when they start shooting the generals. And so let's get on to what else I want to talk about, which is Jeremy Grantham, but also this this graph on the screen now is from ARK Innovation. Again, ARK shows the graph that the median price to sales ratio of the top 25 holdings back at the peak in March 2021 was over 36.1, and now it's 6.3, which is below the COVID lows and goes way back. So, people kept telling me 30 price ratio of 30. Over 30 was fine. Over 35, fine, no problem. These companies are growing like weeds. They're fine, and now we're back to 6.5. So was it fine? Was it fine to buy there in particular? No, it was not. That was pretty much. This is a bubble, a classic bubble. And Kathy Wood kept saying wasn't a bubble. It's not a bubble, but yeah, it was. I'm saying it. And so back to Jeremy Grantham. Jeremy Grantham has been very bearish. He's known as a sort of perma-bear, but I don't think that's right because if you go back to one of my episodes, Investing when Terrified, where he wrote a thing right at the bottom of the 2009 stock market and said it's time to get back in, it's time to invest. investing when although it's terrifying, do it now. So he's saying Jeremy Grantham is sticking, this is headlines, Jeremy Grantham is sticking with his call that the stock market is in a bubble akin to 2000. Grantham said he expects the S&P 500 to fall at least 40% from its peak. In a CNBC interview, we should be in some sort of recession pretty quickly. Also, he says there's a recession coming, and he also said, we'll look at the video, see what he says, because it is interesting, I think, to see in his own words, what is he saying?
Called the really great bubble.
Okay, let's go back to the beginning. Sorry.
I only specialize in what I call the really great bubble. If you go back to 1929 to 2000, to Japan, and the housing part of the housing bubble, and you ask, how did conditions look? Profit margins looked great. The forecast was great. There was no chance of a recession. A few months ago, smart people were saying there was a 20% chance of a recession in 3 years. I mean, it is quite amazing. And what happens after the bubbles break is there's always a recession pretty quickly. And people never get it. People never forecast it. And along with the recession comes a drop in profit margins.
Okay, so saying there that, conditions seem pretty good right before a bubble bursts. And, especially in 2020, people said, as I said, price ratios of 30 were fine. It's all fine. Everything blue sky ahead. What could go wrong? The Fed will save us. And of course that did not happen. And we're now in a Nasdaq bear market and a recession on the way, which a lot of people, as he said, didn't pick. And now we're kind of in danger of recession hitting. Because this bubble, he's saying it's a bubble that's bursting, starting with that emerging tech back in early 2021 and hitting now the generals being shot. Let's see what else he has to say.
Going into the bubbles breaking, profit margins are always at a peak. Bubbles don't peak for no reason. They peak because economic conditions are nearly perfect. And that includes low inflation and high profit margins. And the first thing to go in a recession, of course, is the profit margin. And that is very likely to happen this time. We should be in a recession, mild or severe is the question. But we should be in some sort of recession fairly quickly, and profit margins from a real peak have a long way that they can decline.
Yep, so saying profit margins of companies will decline, which could be a surprise for many. I was talking to somebody about Tesla this morning, who's somebody who's all in on Tesla, all in, and I was saying that's kind of really, I think that's really risky. Even super concentrated portfolio of, I think Norbert Lou's got 3, so why not 3? Why one? Get these black swan events. But what if Tesla turns out being in the auto industry, more than 90% revenue from auto? What if it turns out to be cyclical, even though it's got high demand? Could people start dropping off waiting lists, even if even if there was the perception of that? Could we see in the profit margin maybe get squeezed? Raw material prices are really high. I mean, I could see something happening there, even though everybody sees blue sky ahead for Tesla. I could see that happening. It's not investment advice or anything, it's just my opinion, but it'll be interesting to see. It's down at nearly 43% already, Tesla, actually, from the peak. Okay, let's see what Jeremy Grantham has to say more.
And if you want to get into the longer term, I think this kind of 2000 bubble that we have is dangerously likely to morph into the 1970s, where inflation is always a part of the background discussion, and where growth rate starts to dwindle away. So you have shades of stagflation as we had in the 70s, where commodities are intermittently scarce, price jags here and there, as we have seen recently, where the whole system is so strung out and so borrowed that it's lost its resilience. All you have to do is cough in COVID or a war in the Ukraine, and you see the problems ricocheting around the system that was not designed to absorb any kind of punch. Last-minute inventory delivery, no reserves, putting all of your business with one country far away. no flexibility, no resilience. And now we begin to pay the price.
Well, I hope that doesn't happen. Talk about a 70s style situation where there's high inflation that's really hard to get down, goes on for a long time. The stock market does kind of fairly badly through the decade, and we've had a decade of really a boom time, growth, boom. So are we in for that? I don't know. I mean, I hope it doesn't happen. And but it's interesting to see Jeremy Grantham because so far he's been right about picking the bubble. He said, from emerging tech. He says it's most like in history, being a student of bubbles. He said more than 300 bubbles he's studied. It's most like the 2000 tech bubble, and we are kind of seeing that playing out, aren't we? Where the emerging tech got hit, and then nearly a year later, not quite a year later, we started to get some of the big techs being hit. Even Tesla down. I picked Tesla going down along with the rest of them last February, but it took more than a year. And let's see what happens. I don't know. People, Tesla investors see it'll bounce back, but we're seeing Apple and a lot of the so-called safe havens being hit now. Amazon really hasn't done anything for 2 years, and it's down a lot too. Of course, Facebook, Netflix, we're seeing these are being really smashed at now. So it's going to be interesting to see what happens. When's the bottom? We don't know. Could go on further. It could head back up soon. Just don't know. Impossible to predict. But that's kind of all I wanted to say today. So catch me on Twitter at The Art of Value, and follow on YouTube and Spotify video. I just want to say, interestingly, I'm getting many more people on Spotify than I am on YouTube. Kind of hard, finding it hard to get traction on YouTube with the videos, so especially like and subscribe there if you want to follow on video, but Spotify is good too, and Apple, of course, on audio. Apple's big too, probably the biggest, but Spotify going well, so that's good to see. Alright, see you next time.